Hi there, this is one of my first YouTube videos using my voice and talking about the stock market. I used to dabble in the stock market a few years ago. I was never, a big player in it or anything, but I like to mess around. What we're looking at here is a S&P 500 chart using a weekly term, so each week, each unit on here is a week. And it goes back to 2004 all the way up till present. Now, back when I was dabbling with this stuff, I discovered a technical analysis that seemed to be a leading indicator at times for long-term moves and changes in the stock market. And I found that very helpful because it helps me determine if we're in a long-term bull market or if the bull market is breaking down. And what you can see here is a 100-week stochastic that's been smoothed out a bit. It's this white and green line here. And when that white and green line is bouncing between 80 and 100, it can go a little bit below 80 without a problem. You're in basically a bull market, and there's no need to worry unless you think there's going to be a one-day crash. Now, once it breaks below there, let's say we're down at the 50 mark, which is right about here on the stock market chart. It's the bull market's breaking down, and as it continues to sink lower below there, it's pretty much safe to assume that the bull market's over. Now, it's another measure to predict when the full decline is over, but you can say the bull market's over right about here for sure. How bad will the decline be? That's the next question. And this metric does kind of offer some answers to that I'll reveal later, but for now, I wanted to just take this metric I've made with the stochastic here and try it on other charts, because this only goes back to 2004. So I pulled some historical data, and this is 1995 until present. And it seems to hold true that when you're in a long-term bull market, as seen from 1995 until 2000, that the stochastic does bounce. The 100-week one does bounce above 80 all the way up to 100. And it did touch at this 60 mark, and I'll go into that later. But as long as you're above this range, above 50, and it's bouncing between 80 and 100, you're usually good as far as hanging on to being bullish in the stock market. Now, once it broke below this line, the 50 line here, you're in a bear market, and you would have seen that right about here, and you would have sold well before the bottom was reached, and that applies to the current day one. And so I take it back further, all the way till 1980, back to 1980 to 1994, where the stock market went from 100 to above 400, and it seems to hold true. You had basically no gains here, so it kind of bounced oddly in this situation. But when you reach the long-term bull market beginning in 1982, it held true until the 87 crash. But if you would have known what was up, the 87 crash was not really a full-blown economic crash, but it was more of a computer crash than anything. It was a computer glitch, and if you would have understood what was up, this move wouldn't have counted under this metric. It was really a false move. It shouldn't have been down that much. It would have been more like a bounce at the 60 mark is what it should have been. And anyway, it resumed, and once it was above 80 right here, it would have been safe to assume you're in a bull market, and you were, really. You had another bounce down around this 50. Now this bounce right here could have played you, depending on how you read it. But if this was smooth like it should be, I'm not sure it would look that ominous, because it would be a bounce at probably the 50 mark if it were smoothed, and it would have regained its momentum right above the back above the 80 right here, and you would have been invested again right about here. So you would have caught the next bull market without a problem. Now, going to what concerns me about the current stock market is you have this. All right, you have this rally we've been in since '09, and the recent decline has brought us below the 50 mark. So we're not necessarily in a healthy bull market anymore now that this decline has occurred. You know, it might bounce back up from here and bounce around between 80 and 100 and be a bull market again. That's a possibility. But, you know, if you look at that chart, I mean, yeah, that happened right about here. So it is open to interpretation as far as what's going to happen from this point forward. But at the very least, you can say you're not in a healthy bull market by this metric. A bull market that just has steady increases where it just a slow plot upwards. And that's supported by the VIX. Obviously, the VIX is showing a high volatility rate, well above normal. And that brings me back to the 1960s all the way into the 70s. The stock market went from 60 to 100. Yet there was about a 10-year period here or more where the stock market basically went from 60 all the way back down to 60. It did nothing in that period, and the stochastic here is very volatile. It's bouncing down to 20. It's bouncing all the way up to 100. It's just back and forth, back and forth. Now, yeah, if you probably could have caught the better parts of the bull market, the top ends of these bull market moves, but you would have been whipsawed by this metric in this period. But that's sort of supported by the stock market. I mean, the stock market was very volatile, so that's something you have to read in this metric. If you believe we're going into a long-term bull market, then you can measure it with this. You can just kind of verify and tell yourself, okay, yeah, we're still in it. It's still going on. Don't doubt the move. If you're above 80, just go with the trend. And once you break below this 80 mark, down around the 50, you need to start questioning the trend. But that brings me to the final discovery I made with this. I'll go to the current stock market chart from the last crash. You can draw this line here. See, before the market breaks down, there's usually a break below the 80 mark, which is kind of peculiar. Right here, right before the top occurs, there's a pullback that breaches this 80 level, and if you draw a trend line from there, you usually find something around here in the decline that it bounces against. And you can draw this trend line, and where it intersects the rising on the stochastic right here, where it intersects, that usually proves to be a good time to buy. So you don't have to wait for it to break above 50 or to break above 80 before you say, okay, we're in a bull market. It's not all that bad just to just say, okay, when it breaks above this trend line, we're in a bull market. It's going to be bullish. Who knows for how long? It may not be a long-term bull market, but at least it's going up from here. And if you take that back to the 1990 chart, you have this pullback in 1998 right here, and you could draw a trend line probably all the way from back here. You see that trend line right there? It broke right about here. Bull market time, right about there. So you would have caught it way before it broke above 80. Way before, it was about 50 when it broke, but you would catch it a little bit earlier that way, and it would be more beneficial to catch it earlier. You'd catch more of the move that way. And it doesn't work on all the charts, obviously, but you can draw trend lines with these. Like this one, you could probably just draw a trend line downwards, and when it broke, obviously there's a gain there to be had, but it's it's not infallible. I think you would have had maybe one here. No, probably not. No, because there was no decline. No. Anyway, obviously wouldn't work that well. See, you have one here. You have some here. You do have one there. Here you don't really have one. Well, no, you do actually. Right there. It's very steep. But you would have realized right here that the bear market, it's not going to be a full-blown bear market. It's going up. So you can use that about. It looks you can at least use this about 60% of the time to determine if the bear market's over. Now, as to the current chart, what has me concerned is we've bounced down to this 50 level, and on previous charts this could have gone back up to above 80 and been a full-blown bull market again. But given the fundamentals of our economy, I don't know if that'll happen. I think it's definitely going up because I think we're going to have a good holiday season. And I don't think the debt crisis is going to be a problem until next year. I think they've pushed it off far enough to the point where it's not going to blow up in the next 3 months. So, as long as that holds true, then I think the stock market's going to be kind of bullish here. But, we'll see. I mean, it could easily just tank right down to this 20 level. I mean, there's no reason it can't if things go wrong with this. But it just paints a picture where the stock market is obviously not in a healthy bull market. It's in some kind of volatile situation. It mirrors the 1960s and the 1970s more than it does the 1990s. So it's just painting a picture of a really volatile market, and look out. And hope you watch more of my videos. I might be making some more of them, so thanks for watching.